Good afternoon, everyone. We've had a few new Futures Volatility Box members, and some of you have requested some videos breaking down activity inside of our futures models. So this video is exactly for you. I'm going to focus on the four major index markets in today's video, and we're going to take a look at how did our Futures Volatility Box models do, where were the different trade setups, which were valid, which were not. It's going to be a slightly longer video, but I hope it's helpful for all of our new members. Now, first off, we support 10 major futures markets, and out of those 10, 4 of them are the major indices. So we have the S&P 500, and we support both the full size and the micros, so you can also see MES here. Then you have the Dow Jones along with the micro Dow. Then you have the Nasdaq along with the micro Nasdaq. And then finally you have the Russell along with the micro Russell. So you have the 4 major index markets. And today, 3 out of the 4 index markets were giving you clues one direction. One market was slightly different. It was an outlier. So that right away gave you clues around volatility. I'll show you how to read that in today's video as well, along with the different setups we had. The best setup was inside of the S&P 500 here, just to give it away. And that was a really nice runner that we had. It even hit the second target. It was good for more than 14 points. So we'll spend some time breaking down the trade inside of the S&P. We also had some losers. We had a loser inside of the Dow. So we'll take a look at this loser. For those of you that had it, we'll confirm if you did anything wrong or if you followed the trade plan rules. So it wasn't rainbows and sunshine. However, we did end the day up handsomely, essentially due to this S&P 500 trade. And there were a lot of different learning lessons from today's activity. So let's get started. Now, first off, we have the morning volatility. And what I mean by that is the first 30 minutes after the market opens, and really we use the full hour. So you have the 6 to 7 a.m. Pacific hour. That gives you a lot of clues around the volatility to expect for the rest of the day. Now, for our major index markets, we start with our Scalper Volatility Box models. And you should notice up here, I have 5 different models loaded in. We have the Scalper, we have the Aggressive, we have the Doomsday Aggressive, we have the Conservative, and then we have the Doomsday Conservative. And these models scale up. They scale up both in terms of risk and in terms of the volatility that you need to adapt to. So for those of you that were trading during, say, COVID era, March 2020, the Doomsday models in particular were quite useful, where the Scalper models really just needed to be sidelined for that specific moment. Right now, with the little volatility that we've been seeing, it's been the Scalper and the Aggressive models where we've spent most of the time. Now, the S&P today was no different. To figure out which model we use, we study this first full hour's worth of activity, and we ask ourselves one very simple question. Did price action breach either side's cyan lines? You'll see that right here. These are the cyan lines. And if price breaches that, then you need to pay some attention and see what happens. Say we're looking for a long side, does price bounce? Or do we see sellers continue to keep driving price action lower? If price bounces, then you know that the Scalper models are being respected and buyers are stepping in and defending price where you would expect. On the flip side, if price breaks below our Scalper models, then that tells you that sellers are very much in control. Don't be looking at scalp opportunities today. Instead, you need to switch to the Aggressive Volatility Box models. It's a very simple way to read morning volatility and make some sense of it. Now that you know that simple skill, let's put it to test. So the S&P today, ask yourself, did it hit either side cyan entry lines? Your answer should be no, so the S&P said, hey, continue to use the Scalper models, look for some scalp setups. Let's look at the Dow. The Dow, ask yourself the same question. Did we hit either side cyan entry lines? The Dow, yes we did. We went all the way up, we rallied into the upper cyan entry lines, and then you'll notice we did see the sell-off. So we saw sellers come in and defend price right where we would expect. Again, giving you confirmation that scalps are working inside of the Dow. Now you switch over to the Nasdaq. What about the Nasdaq? If I zoom in here, it should be a little bit easier to see. The Nasdaq did not do the same thing. Unlike the Dow, which rallied, the Nasdaq instead sold off. And when we sold off, we went outside of our volatility box clouds. You can see that very clearly. That's your very clear sign that, hey, the Scalper models are not being respected here. We did not see the buyers step in and defend price at the cyan entry line. Instead, it slipped. Sellers were able to go all the way outside of our clouds. That's telling you preemptively expect a little bit more volatility inside of the Nasdaq. Switch over to the aggressive volatility box models. And that's what we did. And finally, you have the Russell. We come back into the Russell, load in the Scalper, and same thing. We look at the morning volatility, no sign entry lines breached, continue to use the Scalper. So let's do a quick recap. We had 3 different markets that were on their Scalper, and that was the S&P 500, the Dow, and the Russell. We had one market which very clearly was showing you a little bit more volatility, and that was the Nasdaq futures. So right off the bat, if you're looking for a little bit of trades where you have to put less risk on the table, less volatility that you have to deal with, you know the 3 markets to focus on, and you know the 1 market to ignore. For those of you wondering, by the way, for that morning trade inside of the Nasdaq, if you did take it off of the aggressive, which mind you is definitely a much more advanced trade. I've detailed it in some previous videos, but we did have the V-shaped reversal here. This trade was not for the faint of heart. The risk involved on this particular trade was 112 Nasdaq points, which is more than $2,000 worth of risk per contract on the full-size contract. So with the aggressive models and the volatility in the Nasdaq, you did have to be okay taking that good deal of risk, but the trade did result real nice for a day done almost right off the bat before 8 a.m. even hit. So that was the trade inside of the Nasdaq, the morning trade, which is definitely much more of an advanced trade. If you're new to the volatility box, the first 30 minutes is purely for observation, and I would continue to do exactly that. Now we come back into the scalper models, and we know that we had the S&P 500 on the scalper. Now we wait for a setup, and our setup is very simple. We need to see price action breach either side sign entry line. So we have the 7 to 8 a.m. Pacific hour, and you can see very clearly price just chops between our models. Then we have the 8 to 9 a.m. Pacific hour. Same idea, we get close to the upper edge of the models. In fact, we tag it, but right away we go and hit our T1. What's our T1 if you ask? Our T1 is the same amount of points that we risk, which are entries at the sign line. Stop is outside of the clouds. The risk on this particular trade was right around 6 points, and we're looking for the 6 points for our first target. Hit that before we even had an opportunity to enter. And that's right before the lunchtime hours, so no big deal there. You will see, though, that led to a really nice sell-off here inside of the S&P 500. Now, with that sell-off after the lunchtime hour is where the actual trade setup came. We had price fall all the way into our volatility box models for a long side entry here. The entry was right near 7666 inside of the S&P 500. The risk on this particular trade was 4.25 points, and we were looking for that on our first target as well, which happened in this green candle. After we hit T1, stop is moved to break even, and the second target is at the other side's gray target line, which is 14 points away, closer to 76.80. So that was the trade that we had inside of the S&P, which actually gave us an opportunity to enter. We had price breach our sign line, and we had the edge signal confirmation along with the actual entry at the sign line. So everything clicked here. Our setup rules met exactly per our trade plan. Now what's interesting is this move took us all the way now into the other side's volatility box lines. So we go through this trade one more time, trying to see was this a valid short. So one more time, we had a breach of our sign line. We had the edge signal confirmation, so step 1 and step 2, but we never got the retest of our sign line. So my limit order never got filled here, but if you did have that limit order and if price did come right back, that is a very much valid setup inside of the S&P 500, looking for the same exact thing we just talked about. The risk on this trade would have been 7.25 points, looking for that same 7.25 to the downside, and the second target 9 points away at the gray target line. So the S&P gave us the most amount of breaches today and also gave us the one valid setup today. And that setup gave us a real nice trade, plus 4.25 for the first target, which was hit in this green line. Entry right here, first target. And then the second target was at the gray target line of that same hour. Now we move on to the Dow Jones. Now next, I want to talk about the Dow and the Russell. In both the Dow and the Russell, the setup was kind of similar. You had the breach in the same 10 to 11 a.m. Pacific hour, but what's interesting is price ended up going outside of the clouds here before we actually saw the reversal. So the first trade off of the Scalper models inside of the Dow and the Russell was both a stop out. If you take a look at the Dow here, the Dow was an entry when you had price action breach our sign entry line. Then we had price action give us the edge signal confirmation, and we had our entry below the actual sign entry line. This got taken out when price went right outside of the clouds. It was for a wick. If you didn't have any buffer, this was taken out. The risk on this particular trade was 26 points. And with that stop, regardless of if you were spared, that was our very clear sign that, hey, sellers here are pushing price a little bit lower. We want to be more careful. Switch to the aggressive models. This was the same setup you had to do inside of the Russell as well. And once you switch to the aggressive volatility box models, we had the same breach one more time. You had the edge signal confirmation, and off of the aggressive models, we had a much nicer trade. Now, I wouldn't blame you if you didn't take the second entry off of the aggressive models, but the rules on the aggressive models were still met, and this was still very much an active trade setup. If you did take just that S&P trade, along with the Dow and the Russell, you still had a really nice day. If you did have the Dow and the Russell off of the aggressive volatility box models, then you had an extremely nice day where you hit T2 across the board on 3 different contracts, or 3 different markets, So depending on the way you played it, you had either a good day or a great day, but in either case, you had a lot of clues early on in the morning around what kind of day to expect in the 4 major index markets. Hope you found this video helpful for all of our new Futures Volatility Box members. If you have any questions, feel free to send us an email, else I'll see you in the next update. Take care and good luck trading.